This data represents a 100-trade backtest of standard order block setups. While the win rate sits at 43%, the account grew by 47% due to a consistent 1-to-2 risk-to-reward ratio. Identifying a valid zone requires 3 specific criteria. It must create an inefficiency, visible as gaps between candle shadows. It must fracture market structure. And finally, the zone must remain untouched by price until the point of entry. The 57% failure rate occurs even when these 3 rules are perfectly satisfied. This suggests that textbook definitions often fail to account for how institutional liquidity is actually sourced. To improve these probabilities, we have to look past the surface-level patterns and identify the footprints left by institutional order flow. In this scenario, price approaches a visible order block showing a clear structural break. Here, high volumes of retail buy orders cluster. Price frequently breaches this first zone to trigger stop losses, generating the sell-side liquidity required to fill larger institutional buy orders at the lower secondary block. Execution requires ignoring the first impulsive bounce. Instead, place the entry at the lower block, targeting the most recent structural high for take profit. This move through the gold block captures the liquidity needed to fill larger positions at the lower zone before the actual move upward begins. Equal highs or lows are often viewed as stable support and resistance levels. However, these levels represent significant pools of resting liquidity. This pattern shows price spiking through equal lows to clear resting orders. Once that liquidity is captured, price reverses into a new trend, leaving a high probability order block. To trade this, place a limit order at the start of the reversal block, positioning the stop loss safely beneath the sweep candle's wick. Entering after a preemptive sweep allows you to follow a move that has already secured its necessary liquidity. Here, price bounces multiple times off a visible support line. Notice how this support sits just above a valid, unmitigated order block. These repeated bounces encourage traders to place stops under the support line, deepening the liquidity pool before the real zone. By waiting for price to break support, you avoid the liquidity flush, entering only when price clears support and taps the block below. Visible support levels located just ahead of an order block often serve as a catalyst for a liquidity flush into the true zone. Placing blind limit orders at macro zones increases the risk of being caught in a trend reversal. Institutional traders wait for signs that the zone is being respected. Dropping 2 timeframes lower allows you to spot a change of character. This shift in the internal structure confirms that buy or sell pressure is actively entering at the macro level. If the structural shift leaves an inefficiency, the entry goes just above that gap. If the move is efficient, use a Fibonacci tool to find an entry between the 61.8 and 78.6% retracement levels. To protect the position, move the stop loss under each new microstructural low as the price moves in your favor. The micro confirmation acts as final verification, turning a general interest area into an actionable setup. Even the best structural setups require a high-volume environment. Without institutional volume, these zones lack the momentum needed to reach their targets. Focus your execution on the midweek sessions, specifically during the London and New York overlaps, when market participation is at its peak. Priority should be given to recently printed order blocks. As the market trend evolves, the supply and demand dynamics that created older zones begin to dissipate. Low liquidity hours also present a mechanical risk. During these times, widened spreads can trigger stop losses, even if the price itself never actually touches your exit level. Combining structural sweeps with environmental filters creates a framework designed to trade alongside institutional flow rather than against it.